So when it comes to doing a seminar on C Corp versus S Corp, it could be 2 hours, 3 hours, it could be long, and I thought such beautiful walls, I don't want eggs thrown at them. So I decided to put together some bullet point questions that are sensible, that can help both CPAs and non-CPAs and business owners get an understanding of the major change in the tax law. So C Corp, we know the tax rates were lowered to 21% from 35%. The S Corporation, the partnerships, the individuals, that tax rate used to be 39.6. It was lowered to 37 as the highest bracket. And then, of course, as Ron just discussed, the 20% deduction for qualified businesses, bringing that rate down to 29.6 for many people, which widened the gap tremendously between C Corp versus S Corp. So if you're very profitable, you have to take a very close look at what type of entity structure you want to be going forward. So the first question, to not waste a lot of time in billing for clients that don't want to pay for something they don't need. Lou's not here today, right, is he? I'm sorry, I'm just kidding. Do you have substantial taxable income? If you do not have substantial taxable income, do not waste your time, because the tax savings is a deferral. It's not a savings, because in an S corporation, your basis goes up by whatever income you leave in the company, where a C Corp, your basis doesn't go up. So unless you have at least $2-3 million of income, you really should just stay a flow-through entity and take advantage of the 20% deduction. Are you selling within 5 years? So yesterday, at 8 o'clock in the morning, we were at a client. We had a meeting. They canceled, but the 3 tax guys don't check their emails in the morning. Of course, the audit partner, who's here, Bill Fisher, he checks his emails. He's brought bright and early. So we didn't know the meeting was canceled. So we show up there, and they're like, we don't really need this meeting today. We could do this later. It's just, C Corp versus S Corp, you nerds. So I'm like, listen, you should really pay attention to this meeting, because we have spreadsheets that show you could save $2.4 million a year in tax as a C Corp. So then the owner's son is like, cancel that meeting and go into the conference room, and we're gonna have a meeting today. So the meeting went like this. It's $2.4 million a year in savings. He's like, that's great, let's do it. I'm like, well, are you gonna sell within 5 years? Because if you relinquish your S election, there's a 5-year waiting period before you're allowed to make the election again. Said, I have to think about it. I said, well, if you sell within 5 years, it could be like something like a $50 million penalty. He's like, ooh. So see the trap? So, we go through the analysis, and, he says, well, my dad doesn't want to sell. We go through the whole process, and ultimately, we're having another meeting. So the other meeting is 2 reasons. One, they're going to explain to the rest of the management team what this means. And they're also, I told them they have to get a commitment in writing from all the shareholders that if they sell within 5 years, I told them not to, and they agreed in the plan that they weren't going to sell within 5 years. So that's how strong this is for highly profitable companies. It is a big deal. There's a lot of exposure to the CPA firm. If we just willy-nilly go out there and advise, well, you're going to save $2.4 million a year, make the change, and then they sell, then you got to move to another location where they, spaghetti and ketchup, whatever. It's not going to be good for me. Are you holding the stock until you pass away? That's another important question. So a lot of clients have owners who are in their 70s and 80s. I am never selling this company. They should be a C Corp, because when you die, and Lisa Rispoli will opine on this, you get a step up in basis on the stock. So you're a winner when you die in that case, which is, it's not the best tax planning, but it does work. It's effective. Have you already done estate planning? Now, this is a very important aspect of it, because the estate tax is bigger than the income tax. So let's say you're a brilliant guy and you've had these great advisors, lawyers, CPAs, and you own 20% of your company now, and your estate tax liability, you're singing in the rain because it's a $22.4 million exemption if you're married. You're excited. So now there's a court case that happened. Everyone's heard of the ice cream Haagen-Dazs. Well, the owner of Haagen-Dazs had a C Corp, and he didn't realize that people liked ice cream as much when he bought Haagen-Dazs in the distribution. Well, people like ice cream, so it was worth a lot of money. And he was a C Corp, and he didn't want to pay tax at ordinary income tax rates inside the C Corp and then have qualified dividends and have enough money to buy a pint of Haagen-Dazs. He wanted more. So he said, I'm selling the goodwill of this company outside the corporation. I'm not going to pay any C Corp level tax. I'm going to get a flat capital gains tax rate. Phenomenal. He won. So the IRS was very upset, but that, if you go with that route and 80% of the assets of the corporation are in a trust, you now have 200 or 100 or $200 million in your name, and now you got to buy life insurance to cover a $200 million estate. So good for the life insurance industry, bad for our clients. So, you have to look at all those, and the IRS with this new tax law change is going to start to look at court cases that allowed you to sell your goodwill outside the corporation, maybe a little bit more carefully now that they made this tax law change. So there's going to be a lot of changes in the tax law and in the regulations that have not yet been written on all these code sections. A lot of the really big regulations that Ron just covered, like 199A, there's no regs on it yet. So people don't know if you can use a common paymaster to get your wages up between related parties, like you could under the old 199, which was the domestic production deduction. There's a lot of uncertainty. Management service companies, to avoid the 20% loss of the 20% deduction. If you set up a management service company, you can get the 29.6 instead of the 37-point rate. Nobody really has specific answers on this yet. But it's going to be coming, and everyone's preparing for it. So are you growing your company? So interestingly enough, everyone's been reading about the bonuses, right, that everyone got at the end of last year. The Walmart, all these companies were given the bonuses, and everyone's saying, well, it's politics. And, Donald Trump's a pretty shrewd, like him, love him, whatever. He's a shrewd guy, and he knew that these bonuses were going to come because, he's as a tax person, I'm not allowed to talk anything. I know the firm that he uses, and he calls his tax person the little genius, as you can imagine, Trump having a nickname for his tax guy. Well, he's very enamored with his tax person. So the reason why all these bonuses were paid is because there's something called an accumulated earnings tax. That's a tax technical term, a little nerdy, but accumulated earnings tax is very simple. If you're a C Corp, and you don't distribute either in dividends or have a growth model or growth plan, the IRS comes in and says, hey, you're collecting a lot of money in there, and we want 20% of it because it's the law. So I think a lot of companies, when the tax rate dropped from 35% to 21%, realize that they're going to start leaving a lot of money in the company. And it's like, do we have a larger dividend, which is non-deductible, that makes us pay more tax? Do we pay the government 20%? Or do we want to give our employees a bonus and it doesn't cost us anything and we look like heroes? So that's why you're going to see a lot more bonuses from large companies, because they don't want to pay the 20% accumulated earnings tax. So never mess with a guy from Queens. That's the lesson. He knows what he's doing. What else? Do you have foreign competition? Now, sorry, this is going to be involved in talking about the foreign tax law. But as many of you heard, the foreign competition, you may have to be a C corporation. Why? Something called, you ever hear the term the house's money? When a country has a $20 trillion deficit and pays all that interest, someone's collecting it. And those people that collect the interest, they play the long game, not the short game. The long game is 21% tax rate. I'm going to go into the United States. I'm going to repatriate money. Under the new tax law, I pay 21%. It's really not 21%. It's 18.5%, because C Corps still get to deduct the state and local taxes where flow-through companies can't. So now they're paying tax at 18.5%. And under the new tax law, you can write off new and used assets under 100% bonus depreciation. Competition is going to do one of two things. They're going to come in and look at a manufacturing distribution company and say, this is a piece of cake. I could buy your whole facility, write the whole thing off, pay hardly any tax for years, so that just increased the value of your businesses. That's great. Or, why buy them? We'll take our product, bring it into the United States, manufacture it, and we'll just keep building and rolling the profits in. We won't touch this because we're playing the long game for 10 or 15 years. And all the American companies that like to take all the money out to buy homes and second and third and fourth homes and planes, well, we're not doing that. We're just going to keep reinvesting. So there's a double-edged sword of the new tax plan. So I tell people, ready, fire, aim. That's my motto. Don't look, ready, aim, fire. Don't look for the sale of the company. Make sure you have a company in 5 years. Know what's happening with your competition on the ground. So the first big news we've all heard was Apple, right? $350 billion facility in the United States. Wonder why they did that. It's easy money. Makes a lot of sense. It's a smart, I hate to sound like the president. Listen, I'm just telling you, as a tax guy, you're going to be winning so much. I'm kidding. We get beat up. Raise my bodyguard. All right. So the next slide. So we discussed the C Corp tax rate is 21% versus 29.6. It's really 18% with the state tax deduction. C Corp, double tax on qualified dividends. So if you pay the lower rate and then you take the money out of the company, you can't, if you take it out as a dividend, you get taxed a second time. So there's a disadvantage to not growing your company if you're a C Corp. The tax savings comes because a lot of companies will take out a certain amount of wages to reduce the C Corp tax if you're a C Corp, and then you pay tax at 37 versus 21. So there's a 16% delta, but it's still a lot less and look, we have companies that have $16, $20 million a year in profits. So for them, that's how we come to 2.4. That's why I say you need a lot. But even if you have 8 million or 4 million and you're not taking money out, you should still look at the C Corp. Zero step up in basis, I mentioned that. So if you're an S corporation for 10 years and you leave the profits in, when you sell, you could have $15, $20 million of higher basis to reduce the long-term capital gain. But you have to look at the structure of the company. We were at a client yesterday where the owners are 80, 90 years old, and they own 51% of the company. So what does that really mean? As an S Corp, if you distribute out profits, it has to be pro rata, or you ruin the S election. The father and the mother are 90 years old. They don't want and they don't need another $5 million a year in their estate on S Corp distributions. So when you flip the switch to a C Corp, you can just give bonuses to anyone you want, meaning the sons. So they're pretty happy. And now they get to leave another $5 million a year in the company because they don't have to create an estate tax on the father when they take money out. There's so many aspects of C versus S that anyone who gives you the quick answer, just be careful. We talked about the accumulated earnings tax on undistributed dividends, and also New York State. We're in New York. New York has a one formula factor. So if you're a New York State resident and you convert to a C corporation, if you're a manufacturer in New York or a distributor and 5% of your sales are in New York and you distribute throughout the United States, but you have no nexus in those states, so you don't have to file in those states, you just brought your New York State tax that you can't deduct if you're an S corp or partnership down to nothing, because now your company's paying tax at 5% in New York on the 5% of their income times the New York State C Corp rate. Again, are you growing your business? Very complicated. I know. I owe everyone a mimosa this morning for this. It's painful. And again, the state and local tax is not deductible. That was a big penalty for the Northeast. I'm sure everyone in this room has heard that you can't deduct your state and local taxes anymore, up to $10,000, which is awesome because in New York, most people have real estate taxes of like 5 and taxes of, no, I'm kidding. That's That's why a lot of people are very, you hear a lot of people talking about heading south because, Apple's talking about Texas. That's not an accident, right? Silicon Valley, California, 13.3% tax rate. Think twice about California, right? If you're Apple, even though you love the Silicon Valley and Napa and Sonoma, not anymore. They're all going to be barbecue, big barbecue for Apple. They're very excited. So just think about where your workers, employment. So that's really all I'm going to cover today on that. I know it's very dry, but I hope you guys got something out of that.